GILTI explained why zero tax companies can raise your US tax bill. Everyone thinks zero tax means zero tax. But if you are a US person, a zero tax jurisdiction can actually increase your US tax exposure. In this briefing, I'm going to explain why low tax or no tax countries can trigger higher taxation under GILTI rules, and why many offshore structures are built completely wrong. The illusion of zero tax. Entrepreneurs love jurisdiction with 0% corporate tax, no local income tax, no dividend withholding. Sounds perfect. But the US does not care about where your company is incorporated. The US taxes US persons on worldwide income. Remember, the US taxes US persons on worldwide income. And once your company qualifies as a CFC, a second layer of rules applies. That's where GILTI comes in. What GILTI actually is? GILTI stands for Global Intangible Low Taxed Income. It was introduced under the Tax Cuts and Jobs Act of 2017, signed by Donald Trump. The purpose: to prevent US taxpayers from shifting profits into low tax jurisdictions. Here's the key principle. If your foreign company pays very little foreign tax, the US may impose a minimum tax on those profits, even if you don't distribute them. Let that sink in. You don't need to take dividends. You don't need to move money. You just need ownership. Why zero tax can increase exposure? Here's the paradox. If your company operates in UAE Free Zone, Cayman Islands, BVI, any 0% corporate tax jurisdiction, your foreign tax credit is zero. And GILTI calculation heavily depend on foreign taxes paid. If you pay no foreign tax, you often owe more US tax. But if your company operates in a moderate tax country, say 15-20% corporate tax, your US exposure may be reduced because foreign tax credits offset GILTI. Zero tax sounds good, but structurally, it can increase US liability. I repeat, structurally, it can increase US liability. Okay, individuals versus US corporations. Critical distinction. This is where most YouTube advice fails. If you own the CFC personally, you often pay GILTI at individual rates. No automatic 50% deduction, limited foreign tax credit optimization. But if you structure through a USC corporation, the outcome can be completely different. Same foreign company, different ownership layer, different tax results. Structure determines outcome, not jurisdiction alone. The real strategy. The question is not what country has zero tax. The question is, how does this jurisdiction interact with US anti-deferral rules? Serious structuring looks at CFC classification, GILTI inclusion, subpart F exposure, foreign tax credit stacking, QBAI calculations, ownership layering. Zero tax without modeling is not strategy, it's gambling. In the next briefing, We'll break down structuring differences between direct ownership, US holding company structures, hybrid planning approaches. If you are a US entrepreneur building internationally, you cannot afford to choose jurisdictions based on Instagram Reels. This is architecture, not aesthetics. Subscribe if you want real international mobility strategy. Until next time.